Hello friends, welcome back to FNO Trader channel. This is Shakti here, and in today's video it's going to be interesting. We are going to discuss how to use a delta neutral straddle charts to enter and exit straddles on a expiry day. Okay, you would have heard a lot about 920 straddles. Okay, now we are not going to enter and exit on a specific time. We are going to wait for theta decay to start, and then we are going to enter and take advantage of that. Okay, so that's what we are going to discuss today, how to make use of these delta neutral straddle charts to trade confidently and enter and exit before things go south. Okay, let's first understand delta neutral straddle charts. Okay, what are the things that we are going to see today is what is a straddle chart. If you are someone who do not know what is a straddle chart, we'll explain you, and then we'll see what is a delta neutral straddle chart. Okay, so what is this delta? It is one of an option Greeks. Okay, we'll understand what is the role of delta. Then in fnotrader.com, how do we track this delta neutral straddle charts? Okay, then we will see how to use these delta neutral straddle charts to trade them on the expiry day, or maybe one day before the expiry day. We call that either as 0 DTE or 1 DTE. Okay, there is a reason why we don't actually trade beyond 1 DTE. Okay, we'll also cover them. Then the most important thing is what we should be aware of while trading delta neutral straddles. Okay, then let's first start with what is a straddle chart. Okay, a straddle is an option strategy. What it does, for example, you might have seen an option chain and you will have multiple strikes, right? Now if you pick any one strike and you buy or sell a call and put of the same strike, same underlying and the same expiry, okay, you call that as a straddle. For example, Bank Nifty 48,700 straddle position. What we will do is we basically buy 48,700 call and buy 48,700 put, or sell 48,700 call and sell 48,700 put of the same expiry. This is what we call as a straddle. So what is a straddle chart? Straddle chart is we basically plot the combined premium of call and put options of the same strike and same expiry. Okay, so the day starts at 9:15. You pick the call option, specific strikes call and put option price, combine them, add them, and then start plotting every price change till 3:30. When you plot this, you get a straddle chart. Okay, next is, in the straddle chart we have two types of chart. One is a static straddle, what we just discussed, a 48,700 call and put. We are basically tracking this from start of the day to end of the day. So basically we are picking one particular strike and then we are plotting the complete thing, right? So the strike is not moving at all. We call that either as a static or a strike wise straddle charts. Okay, the next one, which is a very interesting one, is called a dynamic or a rolling ATM straddle charts. Okay, what it will do is how do we get this dynamic ATM rolling or rolling ATM straddle charts? Let's say we take the ATM strike. So the ATM strike keeps changing, right? As soon as the underlying goes up, your ATM goes up, underlying goes down, ATM goes down at the money strike. Okay, so you plot the combined call and put option prices of the at the money strike is called a dynamic ATM straddle. So in the previous one we saw that the strike price doesn't change at all, right? In this case the strike price keeps changing. That is why it is called a dynamic or a rolling ATM straddle charts. Okay, now we understood what is a dynamic ATM straddle chart. Okay, next we will see what are the option Greeks and what is delta here. Okay, let's quickly briefly look at it. If you need a detailed explanation of option Greeks and how it impacts, how do we understand this option pricing, we'll have a separate video on that. Okay, now let's move on and quickly see what are the option Greeks that are involved. So there are 5 main Greeks. Okay, delta, theta, gamma, vega and rho. But rho is basically is relative to interest rates, and our interest rate doesn't change when we come to weekly, so we'll ignore rho. We'll focus on delta, theta, gamma and vega. So delta, what it is, it represents, for example, what it tells, I'll give you a very basic explanation. If the underlying moves 1 rupee, how much is the option price moves? Okay, for every 1 rupee movement, underlying movement. So if the spot moves 1 rupee and if the delta is 0.5, then it moves 50 paise. If the delta is 0.02, then it moves 20 paise. So that is what the delta signifies. Theta is, it represents the time decay of an option. So option sellers, they are saying that they eat premiums, or they are capturing theta decay, right? So that is what it is. Theta decay is constant. Okay, for every strike, based on the expiry, the day of an expiry, there is a certain amount of premium that it has to decay. This is a constant thing. Okay, and we have gamma. Gamma basically is kind of a second order. What it does, it will not tell you what has happened to the option price. It basically tells you the rate of change of delta with respect to the price. For example, how much delta has to move will be controlled by gamma. Okay, or it will tell you gamma. Gamma will tell when the underlying moves, how much delta will move. For example, for Nifty, let's say it moves 50 points, right? So for every 50 points, you will see that at the money strike will have 0.5 and then it starts moving in the money, right? Think about, there is something which is deep out of the money, somewhere which is 0.2 delta. Okay, and price started going up, and this out of the money call option is going inside the money or at the money, right? Okay, you will see lot of the price shoot up higher, and that is usually because of the gamma effect. Okay, and the vega one, the last one which we will discuss, is on the volatility. For example, implied volatility, you all know. If you compare, if you convert the implied volatility into rupee terms, for example, for every 1% volatility increase or decrease, what is the percentage movement on the option price will be represented by vega. Okay, so in this particular video, we only have to focus on delta. Okay, because we are saying we are going to make this delta neutral, right? Now we said that for every underlying movement, option price will change by certain amount, which is represented by delta. Correct? Now let's take an ATM strike, because we are plotting an ATM straddle, right? So why do we prefer ATM straddle? Because the premiums are higher on the ATM. We will look at shortly in an option chain where does the premium which is higher, okay, both on call and put side. So premium is higher, so that is why premium sellers prefer ATM strike. But maximum premium means there is also maximum risk. Okay, so in Greek's terms, if you want to say maximum premium and maximum risk, if we say maximum theta is available on the ATM strike. Okay, now let's look at the delta, which is one of the Greeks. What is the delta for ATM strike? Okay, a delta of call will be somewhere near to 0.5 positive side, and put delta is 0.5 on the negative. it will not be exactly 0.5, 0.5, it will be 4951, it will be 4555, like that it will be. Okay, but we will see how do we make that as a delta neutral. Okay, in delta neutral, basically anything that we say delta neutral is basically a portfolio strategy, that you might have multiple positions, option positions, right? Now if you have, some of them have negative deltas, some of them are positive delta. We say anything, if you are on the call side, if you have long on the call side, you have a positive delta. If you are on the put side, you have a negative delta. Now if you combine all of the positions delta, and if it comes to around 0, then you have a delta neutral position. What does it mean? Your position will be insignificant to the directional changes till up to certain price point. Okay, so we will see here what does it mean and how to profit from a delta neutral. Okay, so delta neutral position evens out the response to market movements for a certain range to bring out the net change of the position to 0. A short form answer is, it will basically, your delta neutral means you are basically keeping the position directionless. It doesn't matter underlying goes up or goes down, your position will not change at all. But in real time, that's not how actually it works. So how does delta neutral strategies or traders, how do they make money then? If direction is neutral, Nifty or Bank Nifty can go up or down, okay, but you are not making any money on the direction side. So what is that you actually trade if you are making the delta as neutral? Okay, you are basically trading theta or the vega. Okay, vega is your implied volatility, theta decay is your theta. Okay, time decay of the options is your theta. Okay, let's see actually how does it actually happen in a real-time market, and how do we track delta neutral straddle prices, right? For all the weekly expiry contracts, we identified the ATM strike based on the synthetic futures. Okay, we'll take an example. Why do we consider synthetic futures? And for monthly expiries, we use futures prices, and we compute it on every tick. So you can monitor the prices for IV spikes. For example, if the delta is neutral and if there is an IV spike, okay, if the IV is spiking on the higher side, then you see the option prices go up. Okay, when IV cools up, you will see the option prices coming back to the normal. Okay, because of IV cooling off, plus you also see a theta decay. So both of them work towards making the option prices going towards 0. Okay, and that is what the option traders take advantage of this. Okay, and we plot these delta neutral straddle charts as a candlestick price. So there is one significant advantage, because we are computing at every tick, we have the price at every timestamp, and we are able to, let's say if you want to see it on a 1 minute time frame, if you only calculate on a 1 minute close price at the end of the 59th second, you only have the data point on one particular timestamp. You don't know what has happened for the next past 58 seconds. Okay, with this approach, if you have a candlestick chart, you get 4 different information. What is the opening price of this delta neutral straddle, what is the high price, what is the low price, and what is the close price. So this way you will know if there is an IV spike because of which the price has shot up. Okay, all of that information you will be able to see that using a candlestick chart. Okay, now let's look at how do we use them on a expiry day or a 1 day before expiry day to enter and exit straddle positions. Okay, yeah, now let's look at what exactly this is an option chain. Okay, so if you're somebody who is new to fnotrader.com videos, so head over to fnotrader.com videos and you will have tons of features that will help you trade futures and options very confidently. Okay, take a 7-day trial and use it. Okay, so now let's come back to an option chain. Okay, I'm looking at SENSEX option chain, which is a Friday expiry. Now let's look at it. What is the underlying spot price? The underlying spot price is 74,998. Okay, so what is the closest ATM strike, which is 75,000? This is also the synthetic future ATM strike, so we are good here. So 75,000 is your ATM strike, right? Now you take the call price, which is 206, and you take the put price, which is 260. Then you combine them both and then you plot them, okay, from start of the day to end of the day, every second. We talked about static prices, right? Okay, let's look at what is a static straddle. Okay, you take the strike price of each of them. For example, this is Bank Nifty today's data. Okay, today we had an expiry, right? So 10th April, and I have put ATM +1 -1. That's why we have two strikes here, and I am plotting 1 minute resolution, and then we have multiple periods. I have only selected for today's data. Now the green ones on the left hand side is the call chart, call price chart or premium chart, and then the red ones are the put premium chart. So you combine both of them and then you plot that here on the right hand side, which is the blue color line chart, is your straddle chart. Okay, and the orange one is your strategy VWAP. Now you can see at the start of the day the straddle price has gone up and then it started decaying, not so smooth on strike 48,800. Okay, you have 48,900, which is again plotted here. You can see it is somewhat smoother than 48,800 strike. You can see the movements here. Perfect. Now you have one more strike which I have plotted, which is 49,000 strike. Again you see it's a smooth. So which straddle you will be able to sell it, or you should sell, so that you can get the theta decay, you will realize the theta decay, make profit from it without lot of fluctuations. Okay, suppose you have sold a straddle here when it is piercing down on the VWAP, you can see that it started giving lot of heartburn here because it started going up. There is lot of fluctuation here. Okay, but you see, if you would have sold 48,900, you would have been pretty cool because your MTM fluctuations are not that much compared to your 48,800. Okay, you can see here, compared to, you can see that here. Okay, this is on the static straddle. Now you are going to execute any particular strike sell option, right? You basically sell your call and put for a particular strike, but which strike to sell will be identified using the dynamic ATM straddle. Okay, so let's look at what is a dynamic ATM straddle. You can see this is today's chart, Bank Nifty April 10th, and I have put a 3-minute time frame chart, and I'm looking at a 1 day's data, which is today's data. Okay, you can see the day started at 48,800, it came down, the straddle actually moved to 48,700, then it moved back up to 48,800, and then it's moved up to 48,900. Okay, let's look at let's look at the Bank Nifty chart as well, so that we will be able to see. Yeah, this is the Bank Nifty ATM chart. Let's look at only Bank Nifty chart here. Okay, so this is what has happened. What has happened here? The market opened gap up, it fell down, which increased the volatility of that particular instrument, and then it started going up, which will, the IV started cooling off, and then because being an expiry day, you also have theta acting in your favor, and your IV is also cooling because market is going up. There is no panic in the market. Okay, people are not paying extra or a premium price on the call or put options. So that is what you see here. So market came down and then it started going up, and it started consolidating around this, and then second half it started going up. Finally it started falling at the 3 o'clock onwards, 3:10 onwards it started falling. So this is how the Bank Nifty spot chart looks like. Okay, now you see here, when market fell in the first few minutes, you see the IV started spiking, and this is a delta neutral chart. In a delta neutral chart, your direction is neutral, correct? So the only thing that makes the price go up is the Vega, or your implied volatility. That is what has happened. And around 9:30 the IV started cooling off, and you also have theta decay acting upon it, and you get a good decay here. Okay, and then there was a spike which moved to 49,000, and that was the ATM strike for this particular period. And then it started going back to 48,900 strike, and then you see a good decay from 11 o'clock to almost 2:30. Okay, 48,900 was the strike to be on. And then from this point you see there was an IV spike here, and then it started cooling off, and the strike to be on is 49,000. Okay, so you can see which strike, what is currently happening in the market. Everybody is doing a time based straddle. 9:20, think about it, 9:15, this is 9:18. 9:20 straddle, if you would have executed somewhere here, and immediately you will start seeing a drawdown on your position. MTM would have been on the lower side or a negative side. Okay, and then it takes some time. Today is somewhat okay because immediately it started going down, but for first a few minutes you would have seen a MTM on the negative side, and then it started going down. Okay, and then you started being on some of the ATM strike. You will see there was a spike, and then the strike change, right? So let's see, using this chart, how you can actually trade straddles. Okay, now you see the straddle, you see that market was going up. Okay, green candles on this delta neutral chart. You wait for things to take a turn. Okay, you will enter somewhere here if you are an aggressive seller, or if you are somebody who wait for things to settle down, you will enter somewhere here when the straddle price was somewhere around 270 to 260. If you are an aggressive person, you will enter somewhere around 300. Okay, so this is where is a good time to enter a straddle. And then which strike you will enter? You will enter somewhere in 48,900. Okay, and that is what is the strike that is currently there, and you will start trailing the straddle prices. Okay, you don't have to put each leg 20%, 50% SL, all of that. Okay, you trade very methodologically here. Okay, and you don't have to put lot of 50% SL or something, because you will always know that when is the decay starting, when is the IV cooling off, and then you will be able to immediately enter. Okay, so you will keep a very small stop loss. We'll actually see how you can keep a stop loss which is closer to the price. Now you looked at it, you see the price behavior, it was a good day, but there was a spike here, and then you see that it wasn't going up, so immediately you will re-enter if you would have got exited. And then you started seeing this one, and then you see there was a big spike here, there was another spike here. So if at all you got hit by your stop loss, you will immediately re-enter in your next candle itself. Okay, so this is what you see here, right? Now let's see how you can keep your stop loss. Okay, so this is where the day started. So you can see what is the strike price that will be applicable at the top. You will have a marks here. Now this is where the consolidation happened. The market gone up, and then it started going up. In this candle you see the super trend turned to negative. Okay, so you sold the straddle here. Which straddle strike? 48,900. Okay, and then you kept keeping the position intact. You will see what is the strike. It has moved up to 49,000. You can either move up, or since market has not gone up much, you can continue to keep 48,900, and you can also add 49,000, or you can move the strike from 48,900 to 49,000, completely up to you. Okay, and then you see again it has come down to 48,900. Okay, so you will see that there was a smooth decay and there wasn't much to worry about. There wasn't much spike. Even when there was a spike, you have a stop loss, which is a super trend you are following. Okay, so I have put a super trend of 10 to, you can have super trend of 10, 2.5, or whatever number that is convenient and working for you. Okay, you can see that it has gone up. Even when there is a spike here, you have still not gone out of the straddle. You see here, this is the place where the your stop loss got hit. So you entered somewhere around 290, 300. Okay, or if you are somebody who is less aggressive, you entered somewhere around 276 and you were in the position till 90. Okay, so somewhere close to 200 points you have gained by trading this one. And then again another entry you have got immediately when it started cooling up. Okay, so again you entered somewhere around 88 and then you continue to hold till it moved to 14 rupees. So again here another 70 points. So almost to 270 points you have caught by this one. Okay, you can see the same thing for, let's say, Nifty here. Nifty also was an expiry. Let's look at how the Nifty has gone. Okay, so you can see Nifty is good. Again, let's change it here as well. So you have two places where you can see. Okay, okay, so this is the Nifty. Again here there is a good decay. You can see the strike. We are at strike 22,700. You can see the strike here 22,700, and you got a good decay here. There is no strike change at all. You continue to hold the position. So you entered somewhere here in this 100, 105, and then you will see until you see MTM loss or profits evaporating on this candle, right? You see here you were holding on to that position till 38 rupees on the premium. Okay, so let's see with a super trend chart whether we got any exit. Yeah, we got exit somewhere here around 40 to 43. Again you got one more entry somewhere around 44. You re-enter and then you hold it till 3 rupees. So this is how you can use this charts to trade the straddles confidently. Okay, when to enter, when to exit, when to re-enter, all that information, and which strike to enter, all that information you will see that in these delta neutral straddle charts. So how do we navigate? So under the strategy section you have the dynamic ATM straddle. When you click that, you will get, and you will have all of the indices here. You can select the expiry, select the resolution. You can change it to line chart, you can change it to candlestick chart. You can plot an ATP as well on top of this. Okay, so these are the things. Now how do you access the ATM instruments or delta neutral charts on an advanced chart? So under the chart section you have an advanced chart. Select them, and in the search you type ATM. Okay, so you will get Nifty Bank ATM for the current expiry, Nifty 50 ATM which is nothing but a delta neutral charts, 10th April, SENSEX 12th April, BANKEX, MIDCPNIFTY select, again Nifty Bank, this is the next expiry, 16th April. Okay, let's look at SENSEX. How did it happen? SENSEX also had given a good decay, you can see, but then what happens, because the premiums are higher, one of the reason that we say that you should not focus on delta neutral strategies in a high premium environment or anything where theta decay is not acting much. So the ideal expiry days to trade is either on a expiry day, which is, for example, Bank Nifty and Nifty were expiring today on 10th April. It's a good day to trade both of these indices. Okay, 1 DTE, for example, SENSEX had a 1 DTE. For example, tomorrow is a holiday and Friday is a expiry. You can see that there was a good decay. But then if you want to keep the delta neutral aspect of it intact, true to its theory, you will have to switch almost multiple strikes here. Okay, but that's not how you trade. You basically wait for certain percentage of the underlying to move before you switch strikes. Okay, so but we track this one on every tick. Okay, so that's why you see the strikes were changing. You can see 75,000, 74,900, 75,000, 74,900, 75,000, 74,900, because as soon as the ATM changes based on the synthetic futures, we keep tracking those prices to capture the decay. Okay, but again, coming back here, SENSEX was also a good day to trade because it was a 1 day expiry. Let's look at something which is expiring for example, FINNIFTY 16th expiry. Okay, you can see here it has gone down and then it gave a good spike here. Again it gone down, there was a lot of consolidation here, then it fell down, then there was a lot of consolidation. So anything that it is the price is going down, one, IV is cooling off, it could be one of the reasons, right? IV is cooling off or there is a theta decay that is happening. Okay, we will also bring in the ATM strikes implied volatility so that you will be able to see whether it is spiking because of IV, okay, and whether it is IV is cooling off on the down move. Okay, so that you will also be able to differentiate the decay is because of IV cooling off or it is only theta decay. Okay, so we will have all of that information. Let's come back to where we were. Okay, we looked at it how to use them on a expiry day or 1 day to expiry. 0 DTE means 0 days to expiry. 1 DTE means 1 day to expiry. We understood how to enter, exit a straddle position. Okay, I see a spelling mistake here. It should be exit or re-enter a straddle position and what strike to select. Okay, so you not only know when to enter and exit, we also know which strike to enter and which strike to exit and which strike to re-enter. Okay, now let's see what are the things to keep in mind. What are the pros of this approach or advantages of the delta neutral approach? One is it hedges against small price movements in either direction. Remember, small price movements, that's the key. Okay, it allows option traders to focus on non-directional strategies. Okay, non-directional means you are keeping the delta neutral while you trade your theta and your vega. Okay, so that's what we actually did it on the delta neutral straddle. Then flexibility in establishing delta neutral positions are easier. Okay, we see that it is good. You are able to trade your volatility, or people call them as vol traders, right? Short vol traders. Basically they are trading the volatility. Okay, so what are the cons? A large sudden move can produce a directional exposure because of gamma. Think about it. Whenever ATM strike has the delta of 0.5, right? When price moves immediately higher or lower, then what happens? The delta of that particular strike, if it is going outside the money, then your delta becomes 0.3, 0.2 like that. On the other side, your delta becomes 0.7, 0.8 like that. Now you are no more delta neutral, right? So you are exposed to directional, and that is difficult to manage because if the move is sudden and large. Second thing is, you can see some of the charts that we saw, the strike were changing multiple times. if you are trading especially on 1DTE. Okay, so managing and monitoring and adjusting the positions for delta neutral could be costly. Okay, because you are, every time when you enter and exit, you pay brokerages, you pay charges, which will add up, and it is time consuming and costly as well. Okay, now you think that, okay, I have a directional exposure. If you want to avoid that and I want to make it into an iron fly, okay, again, iron flies means you are basically shorting the straddle and then buying some OTM call and OTM put to hedge yourself from the directional exposure. When you do that, what happens? Your returns come down drastically. Okay, then it makes no sense to actually trade this strategy if you have a hedge. Okay, a properly hedged iron fly on a 0 DTE is not going to give you great returns. So ultimately, in order to increase the return, you remove the hedge, and then what you will do, you will take the hedges only for the margin benefit, and then you trade a higher position size. Again, that's a difficult way to manage when you are hit with a large sudden moves. Okay, so since there are a lot of cons, and the short sellers basically eat like ants and shit like an elephant, right? So basically you take a lot of small profits, and when these large sudden moves hit, you basically have a lot of big loss. You are sitting at it, which will basically wipe out 1 month, 2 months of profits. Okay, so to avoid all of them, you are basically tracking those charts, tracking those positions, and you come out of the positions immediately when you see that. Okay, so it helps you trade to a considerable time instead of blindly shorting at 9:20 or 10:30 or whatever time that you choose. You basically use these charts, know exactly what's happening in the market, and then trade those moves. Okay, for example, you can see I selected ATM here, right? Bank Nifty here. You can see I have marked consolidation areas. Whenever in the consolidation, whenever it starts going down, and that is when I can take a very conservative positions on the thing. Again, when it start consolidating here, I might be out and watching. Okay, when it start coming down, I might take a position here. You can start monitoring these straddle charts through fnotrader.com, and then devise your own strategies. What works for you, what doesn't. Start with the simple small positions, and then increase your position size based on your capital and your risk appetite. Yeah, that's all for today's video. I hope you enjoy this video, and if you like this video, please like and subscribe to this channel, and comment your questions if you have any. Thank you very much.